All right. Thanks everybody for making time for this. My name is Matt Reger from BlastPoint. I know Tuesday afternoons are when calendars can get crazy, so I promise to make the most of the of your time here today. Quick housekeeping before we get going. Everyone's muted, so if you have any questions, you can drop those in the chat, and as we go, um, and we'll get to them at the end. So also, while you're in there, you'll see a link to our banking scorecard. Feel free to check that out anytime during the sessions. Um, the insights behind today's call are built from data you may have already looked at. What we've done is really package that into a quick assessment that you can run with your own data. Makes it easier to see where your bank actually sits and where the marketing gaps are. So what I really want to leave you with today is three numbers you can pull off your own call report, this week. So let's start to see where they come from. Real quickly, just a brief intro here. I'm an account executive at BlastPoint. We help community banks turn customer data into primary relationships, growing core deposits and accounts without buying growth on rate. The segmentation models behind today's case studies that you'll see are the same ones we run for your book. We've worked with 40 plus financial institutions doing this. And so just wanted to just have that brief bio there before we dive into the data here. Quick agenda just so you know where we're going. First, the benchmark. So Q1 2026 data on what community banks spend on marketing and what they have to show for it. This is all from FFIEC call reports. And then, we've identified three moves, three benchmarks. The top quartile clears that you can run against your own numbers. The first is how much you spend. The second, what that spend returns, and then how that budget got built in the first place. So I'll give you the pure figures on each one and leave you with three numbers you can pull from your own call report data before the week is out. And next, I really just kind of want to dive in and look at what this data shows. So part one, the marketing gap here, it's the benchmark, what the community banks are spending on marketing and what they have to show for it. I want to start by, giving credit where credit is due. Q1 in 2026 was actually a good quarter. Net interest margin was at 3.82%. That's the widest we've seen in 2 years, and return on assets was actually at 1.20%, which was the strongest that we've seen in 8 quarters. So those are real, those are earned, and community banks are out earning the nationals on return. The deck shows 1.30% for community banks against 1.23% for banks over 10 billion in assets. So the structural edge, it's built on local relationships, and that shows up in the FDIC numbers. That's not just a talking point. So really, why are we here? Because the averages hide an enormous spread, and the spread isn't, where most banks go looking for it. So let me show you what that looks like. So here you see an analysis. Again, we pulled the FFIEC call report. That's the schedule RIE for every community bank that filed it. 6 years running was 2020 through 2025. So that's around 3,500 banks with a complete series. We ranked by 6-year average ROA, took the top quarter and then compared them to the other 3 quarters. And the following 3 measures kind of frame the story for us. The first one is notable because it shows really no difference at all. You see marketing spend there. The top quartile was 5.36 basis points of assets. Everyone else was 5.65. Statistically, that's noise. We know that P equals 0.39 there. And you'll notice which direction it runs. The lower performers are the ones spending slightly more. Then we have revenue per marketing dollar. The top quartile was $84.34, and everyone else was $66.68. So we know that's 1.6 times, and it has held every year since 2020. And then how the budget got set. So Cornerstone Advisors actually surveyed the industry this year and saw that 56% of institutions build the marketing budget by adjusting last year's number, not from expected returns. So what you're seeing here is that everybody's spending roughly the same amount, and yet the returns are completely different. And when you look at how most banks actually, set their budget, it kind of makes sense why that gap has stuck around for 6 years. Your customers already trust you with their money. The top quartile just figured out how to make that trust work harder. One statistic I just want to throw out there before we get into the three moves. Just kind of wanted to flag this one, but we know that bank delinquency is up 12 basis points year over year, sitting at 0.70%, and more than half of mid-sized banks in the FDIC, that data are showing a worse non-performing asset ratio than they were a year ago. So not trying to put a cloud over what is otherwise a strong quarter, as we saw earlier, but this is, one line moving the wrong way. And it's really relevant to everybody we're talking to, because a bank that's funding itself cheaply has more room to absorb that kind of pressure than one that's been paying up for deposits. So keep that in mind as we go through the three moves today. All right, let's go into those three moves. The first is benchmark your spend. So we know that every marketing conversation in banking eventually becomes a budget conversation. Are we spending enough? Are we behind the bank across the street? So let's answer that directly, kind of with this call report data. The top quartile of community banks spends 5.36 basis points of assets on marketing. Everyone else spends 5.65. As a share of non-interest expense, it's 2.28% versus 2.22%. Neither of those differences are meaningful statistically. Again, it's just kind of noise there. And I want to make it real. So on a $1 billion bank, the entire gap between the top quartile and everyone else is about $29,000 a year. And the bank's earnings less are actually one spending slightly more. Meanwhile, the top quartile is running 1.63% average ROA over 6 years. Everyone else is at 0.87. That's nearly double the return on basically, the same budget there. So that's kind of the data around move one. I want to show you what that looks like in practice. So the call report can't tell you how any bank actually allocates their budget, just how much they spend. So let me show you what that looks like here in practice. So we worked with a regional financial institution and ran, the same approach we'd use for any of you. Instead of blasting broad direct mail across their entire market, they used behavioral segmentation to find the specific households most likely to open and fund an account. So what they saw based on that was 80% reduction in cost per acquisition. It was $60 per new checking account against an industry benchmark of around $300. In the first year of revenue to acquisition cost ratio came out to 25 to 1. So just think about that for a second. $60 to bring in a customer who generates 25 times that in their first year. The budget didn't change at all. What did change was how to reach those customers and where to reach them. So that was move one. I'm now going to move into the second move that we've seen here, and that is benchmark your return. So the data behind that, so if the budget isn't what separates these banks, then what is? It's what the budget returns, and this is where the data gets really interesting to me. Revenue per marketing dollar, that's Capital Performance Group's published measure, so it's the industry standard way to kind of look at this. The top quartile is generating $84.34 in revenue for every dollar spent on marketing. Everyone else is at $66.68. Again, 1.26 times the multiple. But watch what happens when you get more selective with the metric. Total deposit growth for marketing dollar, $59.59 versus $42.28. That's 1.41x. And then core deposit growth per marketing dollar, $22.31 versus $12.81 for everyone else. And that's 1.74x. So you can see the gap keeps widening the more specific you get. And that tells us something important. The separation isn't showing up in volume, it's showing up in the quality of the funding being added. So it's not just the ratios. Core deposits themselves grew 4.94% for the top quartile between 2022 and 2025 against 1.81% for everyone else. That pattern kind of holds within asset bands, so it's not a size story among banks under 250 million. The contrast is actually sharpest with the top quartile growing core deposits 3.5%, while everyone else finished the period essentially flat. And this has been consistent for 6 years. The revenue ratio has never left the range of 1.24 to 1.29, and that's not a good quarter. That's a structural difference. So that's move 2, and I want to kind of talk through what that actually looks like in practice as well. So what does the return actually look like when you're not chasing new customers, but getting more out of the ones you already have? A financial institution in the Northeast came to us wanting to essentially grow share of wallet, more products per household, deeper primary relationships, those kinds of things. They use behavioral segmentation to find the specific members most likely to adopt the next product. You can see click-through rates went up 92%. And because they were reaching customers who were more likely to take action, the cost of running those campaigns dropped by 70%. And that's the whole point, really, of this section. The separation between the top quartile and everyone else isn't how much they spend, it's what the spend returns when it's aimed at the right households. All right, and so that's what move 2 would look like in practice. Now I'm going to move over to the third move here, and this is benchmark that allocation. So, we've seen that there isn't necessarily a lot of variation in marketing spending, but the return can be dramatically different. And it's been that way again for 6 years. How does the gap that size survive that long, right? That's the question. So Cornerstone Advisors actually ran a survey this year, and I think actually answers that question. We can see, 56% of institutions set their marketing budget by adjusting last year's number, not by looking at, what worked, not by modeling expected returns, just by taking last year's and tweaking it up or down. And when everyone does that, spending coverage is, which is exactly what we see in the call report. Community banks bunched between 5.36 and 5.65 basis points for roughly a decade, barely moving. All right, and then look at where the budget actually goes. 46% put their largest share into paid search, and then 48% of those same people rate email as their highest ROI channel. The channel getting the most money is not the channel that they think works best in the same survey by the same executives. And here's why, that keeps happening. Nearly 6 in 10 say their core or their CRM systems limit their ability to measure marketing ROI. 31% think they're crediting the wrong source more than a quarter of the time, and not a single institution surveyed could reliably connect all of the key outcomes, applications, funded accounts, balances back to a marketing source, not one. So that 1.26 times return gap has, quietly persisted for 6 years in a market where most banks generally cannot see it. The channels that perform best, like email, organic search, partner programs, all require data quality and segmentation to work. Paid search shows you, activity by tomorrow morning. That's not a preference problem. That's a capability gap. So that's the data on move number 3, and want to also show you what that looks like in practice. So just one more here. A Midwest financial institution, they're a similar size to most of the banks on this call today. They wanted to grow accounts and deposits, and instead of doing what most banks do, which is broad direct mail across the whole footprint. Again, they used behavioral segmentation just to identify the specific households most likely to open and fund an account. And they saw 26 million in new deposits and loans and a 4% account growth on the acquisition side. So same budget, there was no rate change. They just mailed it to a shorter list instead of broad outreach. And so next, those were the three moves. I kind of want to talk to a little bit how you apply this to your specific banks. And here's a quick assessment using the numbers we talked about today. The first, how does your marketing spending compare to your peers? Are they spending significantly more or less than your bank? The second, how does your marketing spend drive financial returns? You may be spending a similar amount relative to your peers, but are you seeing better results show up in your balance sheet? And then finally, your allocation. So two questions there. What share of this year's budget was carried forward from last year? And then what share of your funded accounts can you actually trace back to the source? We know industry-wide, 56% carry the budget forward and nobody can fully attribute. If you could answer that second question with a real number, you already are ahead of the game there. So you run those three numbers and you'll have a pretty clear picture of where your bank actually stands and what conversion to have internally. Now, figuring out which one to prioritize, that really depends on what's inside your own customer data. And that's, kind of exactly where BlastPoint tends to help the peers. If you want to see your own numbers stack up, there's a QR code that I'll show at the end to book a 20-minute call. We'll pull together a customer report on your key financial health, the metrics. If your marketing data is publicly available, show you how your financials relate to your marketing performance there. Yep. And so I'm going to show this, again, if you want to see how your numbers stack up, it's the QR code here. Happy to book 20 minutes. We'll pull together a custom report on your key financial health and metrics, your marketing data, all of those things. All right. So I know we finished a little short there. I think there's some questions in the chat. Jess from our team will share some of those questions. Please feel free to send any other questions over, but we can start to take those.
Yeah, thank you, Matt. I appreciate you walking us through all of that. I guess to get us started, if a bank can't really attribute much of anything today, where should they even start?
Yeah, it's a good question. And, I hear that a lot when I go to trade shows and those kind of things. Attribution can sometimes be difficult. So, I would start with one link that you can establish. Maybe it's funded accounts back to, the list they came from. It's not necessarily channel level attribution across the whole funnel. Like did households we targeted open accounts at a higher rate than the ones we didn't. There's a comparison most banks can build in a few weeks. They can do that. And it's kind of enough to start reallocating, if that makes sense.
Yeah, totally. Thank you. I guess another question would be is, if, the bank's marketing spend is pretty much right at that peer median, is that a good or bad sign? Or like, how should we be evaluating that?
Yeah, if it's right at the median, I wouldn't say it's good or bad necessarily. It kind of almost tells you nothing really. And I think that's the point, right? The spending range across community banks is narrow enough that being at the medium is really the default. It's not necessarily an achievement. The variance is really in what the spend returns, not its size. So I'd run the second number instead.
I guess from more of like the marketing, like spend side of things, like revenue per marketing dollar seems like a really strange metric. Isn't that just a function of how big we are?
Yeah, fair question, and partly, yes. Because we see, spending so similar across banks, that ratio is kind of close to comparing revenue relative to size, which is why I'd pair it to like the core deposit version. Um, that one moves independently, and it's the one where the gap is widest. And I think it was 1.74 times.
Okay.
X, yeah.
Where exactly does that marketing number come from that you mentioned?
Yeah, so that's all from the FFIEC call report. Specifically, it's Schedule RIE, which is the advertising and marketing expenses. It's typically filed annually. There is one caveat to that, though. Banks only report it above a threshold, so the panel kind of skews slightly towards marketing active institutions, but it's around 90% of banks that report that.
And another question that we have is, how are we supposed to compete with what the digital banks are spending?
Yeah, tough one. And I think that's, being asked, it's an age-old question, but you're not going to outspend them. And I wouldn't try. Chime, for instance, I think they reported $500 million in advertising expense in 2025, which is like a huge amount more than you would see from a community bank, close to 30 times a marketing budget. But actually, one of the data points we had from Capital Performance Group actually puts fintech costs of funds at 4.17% against 2.3% for banks in the community level. So they're buying deposits at a premium, and community banks have relationships that they can't necessarily buy.
Yeah, definitely. Well, I think the last question that we have in here, so everybody on the webinar, please feel free to shoot any questions in that you have. But the last one that I have right here is, I think you said, Matt, that Cornerstone says banks spend about that like 0.10% of assets. You said the 0.054%. Which one is right?
Well, they're both right. They're measuring different things. The call report line excludes marketing personnel salaries. A survey captures total marketing investment, including staff. So use our figure to benchmark against call report peers. Theirs is for total spend.
Okay, great. Thank you. That makes sense.
Yeah.
I don't see any more questions in the chat here, so I will hand it back to you. But please, everybody feel free to shoot over questions, even if it's after the webinar. We also have that banking scorecard link in the webinar chat here as well.
Cool. Yeah, thanks everybody for being here. I really appreciate it. We'll send out the slides and the recording tomorrow. And don't forget, if interested, happy to schedule a 20-minute read through on your specific bank, your numbers, and kind of walk through what we're seeing in the data there. But
Matt, we actually got one more question in here.
sure.
So top performing community banks aren't spending more necessarily?
Yeah, they're not necessarily spending more money on their marketing dollars. They're just being more efficient with that spend. And I think we kind of seen that. We saw that in the data there. It's
Awesome.
more
Thank you
about
to whoever submitted that.
Yeah, it's more about targeting the right folks than it is for how much you're spending.
I think that's it.
Awesome. Well, I appreciate everyone who joined. Again, we'll send some materials out your way, and happy to talk further on your personal banks if warranted. But appreciate everyone's time today.
Awesome. Thanks, everyone.